I'm Kevin Slater, Principal and Lead Financial Planner at Slater Wealth Management. Today, I'm going to update you on financial markets and how our investment strategies are doing year to date. When the realities of COVID-19 set in, the global stock market benchmark, the S&P 500 in the US, went down 34%, and the Canadian stock market, the TSX, went down by 39% between February 20th and March 24th. Markets have been recovering since March 24th, and we're up in May by an additional 4.5% in the US and 2.8% in Canada. As of May 31st, the US market is only down by 5.7%, and the Canadian market is down by 11%. So markets continue to improve month over month. Thanks to the Federal Reserve banks across the world's announcements during the month of March to basically print trillions of dollars, a floor has been put under this market. Because of this, we continue to think markets will recover to their all-time highs within 9 months, but we do say possibly could take up to 2 years. The economy could take much longer to fully recover to previous levels. On my blog is a video explaining how markets and economies are two very different things. It's titled Asset Price Recoveries versus Economic Recoveries. For our investors invested in investment funds, at the end of May, we see our most aggressive investors only down 7 to 9% year to date, our balanced investors down 3 to 6% year to date, and our conservative investors are even or even up on the year, between 0 to 2% year to date. Going forward, we continue to target weight our clients' equity portfolios to 75% US equity, 20% Canadian equity, and 5% gold. We don't see global economic growth being as strong as before beyond the recovery for developed nations, and continue to recommend investing in funds that target medium and large-sized companies that have low debt and high cash flow, are well managed and innovative, have the product and ability to expand globally. These are the features we're looking for to invest. These types of companies will continue to grow in a lower economic growth environment. We also continue to like gold bullion due to the unprecedented amount of economic stimulus and money printing. Since money printing became a renewed idea in Japan in the late 90s and in the US in the early 2000s, gold bullion has performed very well, and we continue to see more and more demand. You can print money, but you can't print gold. On the flip side, beyond the recovery in energy companies, we do not see a lot of growth. Although lots of oil supply has been taken off the market to prop the price back up, significant supply waits in the wings. As oil prices rise, the spigots will be turned back on and more supply will offset any demand. Long term, if oil prices go higher, it will likely be due to massive world underinvestment in the sector for an extended period of time, and current oil supplies dwindling rapidly at the same time. Also, demand will need to rise faster than currently expected. Keep in mind, oil demand may peak in the next 10 to 15 years as society moves to electric vehicles and recycled plastics. Given the multitude of factors and the politics involved, discovering the long-term winners in the traditional energy sector may be very tough to identify. We see easier long-term opportunities in other markets and sectors as described previously. That's our thoughts for today. We'll see you in July. To keep you up to date with our thoughts, please subscribe to our blog on our website and follow us on Facebook or Twitter. Please keep in mind, we also offer insurance, mortgages and lending products, and great rates on GICs.